The most important one is the Coatue story. I think we have to start with the money.
Great. All I know about it is a Wall Street Journal story that Michael Dell's family office and Jeff Bezos are anchoring this $1 billion fund. It's a very low minimum. So accredited investors, I believe, is where you have to be 50,000. But I know when I raise a fund, there's a cap. And the cap on an investment fund for venture is 99 investors or up to 10 million. So when I did my last fund for accredited investors, people who make like 150, 200K a year, I can have like 10 million worth of those. But I had demand for 120 million of those, but that's just the rules. Venture capital firms can't do this. But this is doing a different fund structure, which I think is the main piece we have to get into here.
Just going over the fund itself, this is an interesting vehicle, Jason. It's going to target both public and private high-growth technology companies. So the reason why I think this is so interesting for our audience is that it could maybe democratize venture capital and allow a greater pool of people to put capital into a fund that will back private market companies. And I went ahead and pulled Coatue's known 2025 investments per Crunchbase, and they've taken part in fundings for Harvey, Together AI, Mercury, the bank, Island, the secure browser, Supabase, Ender Labs, Clara, Persona, lots of Twist 500 companies. So you can see they're getting deal flow, right? So now Lon might be able to, with 150K check, get access to a lot of really interesting private market shares. So your question, how is this possible? I spent more time today in SEC filings than I want to admit. I have to say, I think you owe me lunch because, oh my Lord. But as far as I can tell with my research and really abusing ChatGPT 4.0, the gist is this is not like a traditional venture capital fund. It's called a registered closed-end interval fund. That's kind of the moniker attached to it.
Registered closed-end interval fund.
Yes.
Okay. So we have to unpack that and explain it in plain English to our audience. I understand that part of this is it's like an IPO and you have to do higher reporting and people can redeem their money on some regular basis. I think that's the difference.
You're dead on. Redemptions in this will be quarterly, up to 5% of the fund's value, no more than that. So I guess if someone else cashes out before you and it hits the 5%, that's it for you. Also, if you take your money out in the first year, you pay a 2% premium, 2% penalty on that. Now, the continuously offered fund, I believe it means that it's going to last for as long as it wants to. There's no set end date to it, Jason. And this is a fund that has been registered under the SEC Form N2. Now, it's different than in VCs, and I have a chart I'll pull up in a second showing the discrepancies between this and a trad venture fund. But the reason why I think they chose this format is because it doesn't have an investor cap. So the caps we know about SPVs or traditional venture funds simply don't apply here. And that's kind of where it gets a little murky. And I actually want to call an accountant to bring them on the show to break down the deepest nuances here.
No, I think you've got the broad strokes. If you're doing an SPV or a venture fund, you can have 100 investors, or I think it's the 99 rule. You can have 99 investors, say in this SPV, special purpose vehicle, or your venture fund, and it's uncapped. So 99 people put $1 million in each or 50K each. If you want to have more than that, they can do a lower amount, but then they cap it at 10 million. So I did that because I wanted people to be able to put in 25, 50, or 100K into our last fund, like friends of mine, et cetera.
Sure.
So yeah, it's a challenge, but I'm thinking about doing more frequent funds. So instead of doing a $45 million fund like our last fund, I'm thinking of doing $25 million funds. So I would have 15 million of that come from what are called qualified purchasers, people with like $5 million in net worth. So they'd be 15 million, and then 10 million from the crowd of people who are accredited investors. But that's still only 6% of the country. And then instead of doing a fund every 4 years, do one every 2 years. And I could raise the funds quicker. And then the hurdle is lower. So if we hit something big, we get into the bonus quicker. So it should be better for IRR theoretically if we hit something. So this is all in the weeds, but more people will have access. And then registered financial advisors, people want to get into alternates. So this is opening up a whole nother group of people to invest in venture capital. Overall, I think it's a great thing.
I think it's an absolutely great thing. And I know that it's going to be enticing to people because as I was reading this, I was like, oh, should we do this? Thinking about my family. I was like, oh, wait, that'd be the biggest conflict of interest known to man as someone who's still a journalist.
Nope.
You don't think?
You know why? Because you wouldn't even know what's in the fund. It would be like buying an index fund. So you would just be putting 50K in and you wouldn't know what you have. And, I'm sure they would send reporting that would, but you could just say, listen, I don't make the investment decisions here. So if they bought I don't know, Solana or they bought Stripe, you wouldn't even know.
If the president can make his own meme coins, you, Alex, should be able to invest in this fund for startups.
All right, Lon, I love you and I appreciate you throwing me a bone there, but I do aspire to a slightly higher moral and ethical bar than the current president who's doing meme coin meetups.
There's your problem right there.
There's your problem right there. Alex, I'm going to go ahead and give you permission to understand what I learned about 10 years ago. No conflict, no interest. I'm an Uber shareholder and I have opinions on Uber.